Hello and welcome back to the Property and Lending Podcast. As always, joined with Fadi and Mark. And usually I don't ask how they're doing because they don't want to make this awkward. But the fans have asked, and the fans want to know about your lives. So, Fadi and Mark, how you going?
It's not so much I'm awkward, it's just that we've discussed how our day's been just before the podcast started. But I think this week we didn't, so we can cover all our feelings.
Tell me about your feelings, Fadi. How are you feeling this week?
This week is just still catching up on some work since I've been back from Egypt. Following up on a few files, new policy changes. Obviously, policy changes are happening nearly every week, it seems. Some of it seems, well, reality is it's every fortnight, which I think we'll be covering some of those policy changes in this podcast, which I'm pretty excited about. But overall, back to normality, I guess, back to work.
That's good, man. And I've been good, very busy. You know, coming to the end of the year, trying to wrap things up. So yeah. I'm excellent. I'm always excellent when I'm on a podcast with Mark. It's like my greatest part of the week. Like especially the opening part where like it gets really awkward. It makes my week. It actually makes me so happy.
And where are you headed towards the end of the year?
We're going to Qatar to watch the Socceroos win the World Cup, and then we'll follow that up with a trip to Egypt, visit the pyramids, and you know some of the mummies from back in the day, see how they're doing. And we're gonna take Mark out of his misery here, and I'm not gonna ask how he's doing, but we're gonna call this segment Mark's interesting tip of the week. to remove the awkwardness. So, Mark, you don't need to tell us how you're doing, but do you have an interesting property or lending tip for this week?
Yeah, so for thanks for the intro. For everyone that doesn't that earns anything that's regarded as non-base income, whether that's allowances, commissions, whatever it is, those are the two main ones. Now that we've passed the first quarter of the financial year, typically your typical average bank now is just going to require your most recent two payslips, which is normal protocol, because the year-to-date figure, so long as the year-to-date figure on your payslip shows the allowances and commissions from this financial year and it's accurate, then we can use that from now on. Prior to this, any submissions with payslips showing anything before October 1st, typically they look at the last 6 months, so it's a lot more paperwork for the customers, and just a lot more draining. It gets a little bit easier for any non-based income applications at this stage to get assessed. A lot less documentation from the clients and less documents for the banks to pick up on and ask us questions about, and then to get over the line.
So excellent tip. I didn't know that actually. So that's a very good tip. And stay tuned next week for Mark's next tip.
Wait, I've got another one. I'm going to forget.
Save it for next week, man.
Remember, but all right.
Now, if you want to, well, we can have two tips today because it's the inaugural weekly tip. So lucky for the fans, they get 2 tips today. Go ahead.
I was just going to say, I recently had a brand new property being purchased, and because it got subdivided after the contract was signed and after the customers, we got them the unconditional approval and the loan document signed and everything like that. Once it was subdivided and there was a new title reference for the property being purchased, it has to go all the way back to the beginning to the credit assessor to change it from his end. It's already approved, so there's no problem, but it goes back to the credit assessor and then new loan docs need to be signed. So if you are buying a brand new property, it's very important to understand if it has already been subdivided or not, and to disclose that to the broker, because if not, the title on the loan documents that have been signed, if they don't coincide with the title of the reference, the title on the property of the day of the settlement, it's not going to go through. There need to be changes that need to be done prior.
So that's also in regards to duplexes that are being built on one title. So those duplexes need to be subdivided because obviously at the end of settlement or at the end of build, that property or those two or the duplex is actually separated and subdivided. Each one is actually subdivided. So that's actually a very important point made by Mark. because it does save not just us a lot more time, but it saves the customer a whole lot more time and less headaches as well. And just to go back on Mark's first point, in regards to the comms and commissions, always keep in mind, I think this always goes under the rug, that anyone that's in pretty much the health industry or anyone that's like policemen, fire brigades, nurses, there's quite a number of lenders out there that use 100% of their overtime, because in those sort of roles, it's pretty much overtime is a big chunk of their income. And if you're a nurse, a policeman, fire brigade, what else is there, Mark? There's a couple of industries in there where lenders will actually take 100% of your overtime as well.
It just needs to be part of your normal sort of work sort of schedule. But if you're in sales with commissions, even if it's normal for you to get commissions, there is actually a business that takes 100%. My vast majority will shade it at 80%.
80%.
Excellent. Thank you, Mark, for your tips. Fadi, next week you got to bring us a funny story that you've experienced, or a good tip as well. I'll leave it up. In
life, or a funny story in life, or
figure it out. See what happens next week, and we'll take feedback from the listeners. But what we're talking about today, so apparently the real estate market is crashing, or that's what the media and the news will have you believe. So we thought we will talk about what the current market looks like from a lending perspective, and then from a property perspective, from buying perspective. So interest rates are obviously going up, and that's the news story of every month at the moment. The last interest rate rise was 0.25%. What are you guys seeing from your perspective as brokers? What's happening in the lending space? Is it becoming really hard to borrow money, or is it just a matter of borrowing powers are decreasing? What are the big four banks doing compared to second-tier lenders? Are there trends? What are you guys seeing happening in the current market?
I think I might have a funny story for you, just going off that point. Mark and I are actually having that conversation today, where we're actually getting a number of calls from a few different lenders in regards to following up if there's any new businesses to be put through. So we are seeing a lot of our BDMs or a few lenders that are calling through to see if there's any deals on our table that we can pull through, which obviously during the COVID period, during the busy times, we don't get those calls because all lenders are quite busy taking applications in and not really following up with brokers in general if there's any new business on their table. So to be devil's advocate, we are seeing a bit of a slowdown in regards to new purchases. We are seeing a number of refinances coming through. Obviously, everyone's taking a look at the current interest rate. Just like you and I and Mark, we're freaking out that the rates are constantly going up. We want to make sure that we're on the best interest rate out there. So we are definitely seeing, I wouldn't say slowing down where it's coming to a stop, but we are seeing less number of purchases, and refinances are a lot more higher, where previously, I think most of last year, KM, for me and Mark, was just constant purchases on a weekly basis, sending customers to yourself in regards to investment opportunities, investment purchases interstate. I think right now with interest rates, currently going up, I think the buffer rate also went up a couple of weeks ago to 2.6%. We are seeing a lot more tighter borrowing policies, and also a lot more new policies coming through. Like I said, it feels like it's on a weekly basis, but ideally it's around the fortnightly to monthly basis that we're getting those new policies coming through. So I don't know. I know from your point of view, I'm going to ask you the same question. Are you seeing a slow or a decline in new purchases, or has things slowed down?
Yeah. I guess we'll get to I will answer your question. But I don't want to jump around, because that was some feedback we also received that we jump around a little bit. So I'm trying to be a bit structured, but I will answer your question. But there's definitely good insight from your perspective, where you're seeing there are less buyers or less applications for new purchases, and more refinancing. And I might contradict you a bit later, but Mark, I guess what are the big four banks doing from their perspective? Are they helping at all, or they're just going along with the RBA?
No,
it's just going.
So it's not even just the big four banks. I mean, pretty much all banks, as soon as the cash rate increases, within a week, maybe 10 days, we get an email saying, as of 4 days from now, our rates will be going up by 0.25 or 0.5%. So they are adopting that. I did see a bank today that went up by 0.1 instead of the 0.25. It wasn't one of the big four. So typically all the banks pretty much have followed at this stage every single cash rate hike that the RBA has done. That's not to say that they will continue to do that, but it's probably a good indication that they will or be very close to it. I'm just gonna say about going back with my sort of with my clients, purchases are actually just as common as refinances. We're seeing a lot of customers get a lot of good deals, with a lot of customers getting deals that no other buyer is competing with them on. There's a lot of houses that they're getting for very very fair prices, very good cheap prices, good properties, where there's not much competition. So I definitely am seeing quite a few purchases on my books. In terms of the big four comparing to the rest, there are some banks that do stuff slightly different to help borrowing capacity. So I'll give you an example. So for example, there's one particular lender that no matter how long left or what your interest rate is on one of your existing loans, not for the loan you're applying for, but if you have an existing property, they are going to calculate it as if there's 30 years left, meaning the repayments are less than if you have 15, 20 years left, allowing you to borrow more. They also, on their calculator, do not ask for an interest rate. They just it automatically declares what, like, you have to put what your repayments are. They don't add a buffer on it, but there's a set repayment that they put for that particular loan limit. Let's say you have 600 grand owing. So that's been helping a lot of customers increase their borrowing capacity a bit. That's not one of the big four banks again. So at the moment now, definitely, you're just going to the big four banks, definitely borrowing capacity has been smashed. I'm about to put up a post today that if your borrowing capacity now compared to in May 2022 has gone down by 25%. So if you were able to borrow $1 million in May, it's now sitting at about 750. So obviously, that's one of the big pressures on property prices from what KM I'm sure we'll end up saying, because it's hard to get money on credit. It's hard to get money on. It's hard to get your hands on money. Sorry.
Yeah, for sure. I guess I can answer your question now, Fadi. From a property, I'm just trying to respect the fans, the listeners. So what we're seeing, I think it really depends on where we're looking. So obviously, you guys know, like, my thoughts on generalized comments, completely useless. So the market is not one market. Sydney is doing very different things to Brisbane and Melbourne, Adelaide, whatnot. In general, like in extremely general conversations, yeah, it is quieter in general. Definitely, like our clients that we're buying for in Sydney, it is easier to buy today than it was 6 months ago, a year ago. However, because that is obviously there's less competition. However, obviously because people's borrowing powers have dropped, they're also not buying what they wanted to buy. So sellers are still sitting. The issue we have here and why the market's not tumbling down 50% or 30%, and why the market doesn't actually crash is sellers are not desperate at the moment. There is no real alarm bells ringing for people who want to get rid of their property. Most people who are selling at the moment have already purchased something else, have another property, are upsizing, downsizing. Like, it's not a matter of urgency because of job losses or interest rate rises and whatnot. Distressed sales and are still at record lows. So people who are selling still want the 12 month ago price, but the people who are buying don't have that money. So the pool of buyers is much smaller. So if you are a buyer, it is a little bit easier to get those deals. And like Mark was saying, at fair price, you're not necessarily getting bargains, but you are getting fair price because you're not competing with so many people that nothing's really causing the price to run away. That's in Sydney. In other cities such as Adelaide, Brisbane, more so Adelaide, Brisbane started to slow as well, definitely compared to the huge run that they had in the last few years. Oops, that's my screen sharing for some reason. But in Adelaide, we have seen no slowdown. It is very, very busy. And I think there are a few reasons for that. I think Adelaide price point is still extremely affordable. So people, especially interstate investors who had 800, 900, who may now have 700 or 600 grand to play with, that is still more than enough to be playing in the Adelaide market and be competing, quite strongly. Problem is, so many people at that price point, that you still have so many competitors, right? So if we listen to the news in the media, it seems like the market is crashing. Here's a story. On last Friday, we put an offer for a property. The property was advertised for 60 to 499, was the asking price. We had done our own valuation on it and said this property is worth 565, so well undervalued. We offered 515,000, so 15 above the top end. The inspection happened and the agent called me and I saw the results. We got smashed. There were 35 offers, not 35 people going through, 35 offers on the property, and we were midway, 15 grand above top end. We were midway, and ended up selling for over 600,000 or something. But that's because we're obviously picking very particular suburbs for our clients based off the data analysis to find these locations. But we're always going to find those locations where no matter what the general market is doing, these areas are going to be quite busy. So the thing with that is there are 35 people who bid for it. One person won. There are 34 people still looking in that location. So all those other properties are also going to get taken up in the area, and there are only about 4 properties for sale in that particular suburb. So where do these buyers go? They stick around, and when something comes, they bid a bit higher. So I think it's, every area is different. And when you're buying in the right areas, the market's not crashing. We've seen with our clients, and I know, like I sent one to Mark to try and help out on a scenario where the borrowing power has dropped from last month. So we're seeing some of our clients have to change with the data and have to act a bit quicker to get in because of the interest rate rises. But from what we're doing, we are competing with a lot of people still. So I would not say from a current market perspective, the market is not crashing. The areas of buying in are going up and going up quick still.
So here's a question for me. In regards to the media talking about, property market is crashing or it's going to drop down by 30%, they can't obviously be generalizing that as a whole nation. From what you're saying now, it's a state-by-state basis. So obviously with Sydney, we're seeing a lot of, a reduction in auction numbers and the amount of people going to auctions. By the sounds of it, with Adelaide, with so much competition there, whether it goes to auction or not, it seems like buyers are being a little bit more proactive, a little bit more smarter, using buyers agencies or, going interstate to look for that better investment opportunity. Are they generalizing that as a nation, or is it state by state, or they're not mentioning it, just an overall media kind of announcement?
Yeah. Well, the news generally is talking, they'll throw out a headline as a bit of clickbait, right, to get you to turn on the TV. And, we'll do the same with the title of the episode. We'll find some clickbait to get someone to click on it. We'll call it market crashing, even though we're talking about the market not crashing, right? Yeah. But the data that they're looking at is a state-by-state data or city-by-city data. Problem is the city is still not one market. I mean, Adelaide is not, even that comment I made was very generalized in terms of what Adelaide is doing. Because if we look at Sydney, for example, no disrespect to the people that live in the following suburbs, but Sydney includes Vaucluse and Campbelltown, and they're very different markets, right? It's a very different demographic. They're very different incomes, very different kinds of people that live in these areas, and very different profiles of these buyers. So the problem with the data is showing what Sydney did. And at the end of the year, CoreLogic might report that Sydney did -6% this year, whatever it is. That 6% is including Vaucluse that may have dropped 5%, and Campbelltown, who's gone up 11%, and then Liverpool, who's gone down 3%, Bankstown's gone up 6%, or whatever. So like, it's taken such a broad look at what a market is doing. It's so inaccurate. So to actually know what's happening, you really have to be like down on the micro data, the micro level data, not macro, because Sydney and Vaucluse and Campbelltown, you got one market of $600,000 properties, and you have another market of $5 million plus, but they're both under Sydney. So a 1% or 5% drop at Vaucluse is very different to a 5% drop in Campbelltown in terms of dollars. So the data that the media is reporting is quite generalized, because there is, I guess, a convenience to that. It would be very hard to report on every individual suburb. You'd need a 24-hour show for that, right? They've got half an hour plus other news. So like, from a practicality, makes sense. But it's an irrelevant metric. It doesn't mean anything. Like, we are buying at the moment for clients in areas it is really hard to buy in, but these people are making a lot of money, no matter the external market factors.
Yeah, it's funny what you just said there. Well, it's not funny. It's actually pretty accurate too. So I have an existing customer that is looking to sell one of his properties later on. He was speaking to a real estate agent. He's in the middle of the build, and a real estate agent that we all know very well. And he was speaking to me. He goes, "Oh, I'm trying to complete my build in time so I can sell it for a higher amount, in this sort of market, in the COVID market." And the agent pretty much said what you said, KM. He said, in these certain areas, like in the area that my customer is currently selling in at the moment, the prices are not going to really drop by as much as people, are claiming it's going to drop by, because people are still willing to pay for that amount. People are still wanting to live in those sort of areas, so they're willing to pay that higher amount at end. And then he brought up, if you're talking about Campbelltown area or those sort of areas where people are just trying to get into the market for affordability wise, there'll probably be a little bit more of a drop in those sort of areas compared to those high-end areas where people are more willing to spend that extra cash or get that extra, lending out to move forward. So I think that's a very important note, especially what you've just brought up now, is that, between two sort of areas, the way the media are reporting it, it's very hard from a consumer point of view. It's hard for me personally to see, what they're really, really discussing in regards to how is this market going to be dropping. So when you say we can do an episode over 24 hours, we can, because every area has their certain value, and people are willing to pay a certain amount to live in certain areas.
Yeah, for sure. And I think generally what happens when interest rates rise, your extremes are always affected the most. Yeah. So your top end, your $5 million plus locations get affected because that 0.5% interest rate increase on someone that has a $5 million loan, that's big money, right? Yeah. So those markets, and you already have a small pool of buyers for these kinds of properties. So when the interest rates go up and these people are affected, that small pool of buyers, which is the demand, becomes even smaller. So you have less amount of demand with, what could be the same amount of supply. And then the other extreme is the really cheapy areas or the lower value areas, is people who are already struggling to get in. So when the interest rates go up, that struggle has become more of a struggle. So again, the pool of buyers, which is the demand, decreases. Everything in between, and in Sydney, I would say that's between 800 and 1.5 million, which is quite a big range. But that's sort of where, if you take into account dual incomes, family incomes, and, high income earners in Sydney, that's probably where most borrowing powers sit within Sydney, or 800 to 1.3 million, maybe 1.5 is a stretch. These areas don't really get affected as much because the people at 1.3 dropped maybe to 1.1. The people at 1.5 dropped to 1.3. The people at 1.1 dropped to 800. And that's such a big proportion of the city's properties. The median property value in Sydney now is 1.01 or something, 1.05. So these areas, the demand might not, the number of people might not reduce. It might be different people dropping into new brackets, but that supply still has an equivalent demand to it, if not more, which, you find these areas not reducing as much. And that's why real estate doesn't, that's one of the reasons real estate in Australia doesn't crash. Like, when COVID started, before you boys joined the podcast, Matt Common, the CEO of CBA, said the market was going to crash 30%. And then I did an entire episode calling him an idiot, right? And this is the CEO of CBA. He's obviously not an idiot. But my point of it was that the real estate market in Australia works very differently to any other investment category. Like we generally class investment as one of three things: business, stocks, shares, NFTs, crypto, that kind of world, and then real estate. There is no really other way to make money outside of these three investments, passively anyway. And the other two are dominated by investors, right? The people that buy these assets are investors. No one buys shares in, whatever, some mining company because they love that company. They buy shares in that mining company because they want to make money. They want that shares to go up. So it's an investor buying an investment. And everyone that's buying that investment is an investor. So when there is bad news or interest rates go up, everyone is equally affected and no one cares about the company and everyone's, all right, let's dump the shares. The thing with real estate is it provides a fundamental need. People need to live somewhere. And it's an investment that is not dominated by investors. 70% of the market are owner occupiers, people who buy property to live in. So the interest rates can go up all they like. And COVID can happen all it likes, and we can have mass pandemics and a whole bunch of other things. People will do whatever they can to cling on to their home. And when 70% of the market is owned by people who live in it rather than people who are investing, and it's not the most liquid of assets, it's not something you can just dump tomorrow like a share. You don't usually get mass crashes and mass drops in the market because it's the turnaround time to sell something is quite slow. And then people also will, they'll get a second job, third job, whatever it is. They'll eat beans for the next 3 months, not to sell their property. During COVID, the mortgagee in possession rates was record low, because people were like, all right, I'm not spending money. I'm going to pick up another job. I'll do Uber, whatever it is, so I can pay for my mortgage. And obviously the government was giving out money as well through grants and whatnot. So I think the same thing is going to happen here. And property is a cycle, and we learn from history that, some areas will go down inevitably because there is less money being spent in the market because of interest rate, as you guys are seeing. But like what Mark saw and said, that the number of refinances and purchases are similar. People are still buying, especially in that range where people are getting fair deals.
And Mark, where are these customers purchasing? So from memory, I think you were talking about customers purchasing in the Moorebank area, Chipo area. Is that the sort of areas they're still purchasing in your customers?
There was some in Sydney, but mainly investors buying Queensland, South Australia.
What about owner occupied? In regards to owner occupied, which areas are you seeing those purchases coming from?
Yeah, like Liverpool region, Liverpool based.
And I think, and the reason why I'm asking, KM, is because what we've just discussed now. So I had a lot of customers last year, as you guys are aware, purchasing, basically the St. Susie, the Rockdale, customers that, went to those sort of auctions because they were given money they didn't have access to before, and they purchased in those sort of areas. So from my point of view, my customer base, where they all purchase in those sort of areas, St. Susie, Rockdale, Brighton, Montreal, all that, that's actually reduced, and we're seeing purchases now moving towards the Liverpool, Moorebank area, Chipping Northern area. So it just actually pretty much proves the point that you're making there, is that we're seeing the differences between those sort of areas where it kind of, people that were able to afford it during COVID has now been pushed down, now maybe brought back to not so much reality, but maybe in regards to those sort of areas they can afford, maybe the Campbelltown, the Liverpool sort of areas. And I think that's where the major difference is at the moment as well.
Yeah, 100%. I mean, Sydney is a great example because of like the literal geographic of Sydney is that we have the city and everything moves out, and literally the further out, the cheaper it gets, right? Whereas Melbourne is a bit more CBD central and it kind of works different. And Brisbane's the same. You have north, south. Sydney is like a really good example visually, where you can see, okay, the closer you are to that city, the more expensive it is. and then it goes out and it becomes cheaper. And when interest rates go up, you literally see people moving further out or buying further out, like you're saying there, exactly, Fadi, because of borrowing power changes. Oh, screen sharing again. So I think you're 100% right. What's interesting though is that we're not, like, from our side, we're not quiet. Like, our business, as a business, we are busy. We have clients, and we're picking up. We just picked up another 2 yesterday, another 2 clients. Like, people are still calling and still wanting to buy property. Might be at a different budget than they would have had 12 months ago, or maybe it's because they're, been listening to our podcast and they're educated and they understand that, that it's not about trying to time the market. It's just getting in because, the market will do what it needs to do. So it's interesting because, when you listen to the media and whatnot, it's very doom and gloom and it's very depressing. But you guys are not getting quiet. We're not getting quiet, and we're not only not just being not quiet, we are getting smashed in the market. Like, people are destroying us. It's very interesting to see. I know, like, we've just purchased one in Perth as well, and there was a bit of competition there, and the Perth data is looking quite positive. I think it will be one of the next cities where there will be a lot of investor activity. The data there is looking positive, so we just picked one up. Brisbane is still a little bit down on where it was, but because it ran so high, the entry point is still quite high for investors. The 500-600 mark is still a bit not enough for Brisbane. But anyone really sub 600, Adelaide is really the spot to be. And then we're seeing some good data in WA and regional Queensland. So the buyer activity has not slowed down. Even regional Queensland or Perth, we've missed out on properties literally over a few hours. A property will get presented off market. Oh, we had one actually there in Tasmania that we're looking at, and it was off market property, and she sent it to me and a few other buyers agents, and within about 6 hours there was like 4 offers, and again we were out of the race. So it's, if you're in the right spots, the market's not slowing down.
So would it be safe to say to get into Brisbane now? Now that you're saying that Brisbane, was at such a high point and now it's a bit slowing down, will now be a good time for customers to start looking at Brisbane, or it doesn't really work that way?
I don't think it works that way. I think it works in terms of, depends what your budget is and what your strategy is. If your budget allows for Brisbane and the data says, well, for your particular position, Brisbane works, buy in Brisbane. I had a conversation with a client yesterday, or one of the clients we signed up, and she really wanted to buy in Sydney. And I was like, why? And, because that's where the capital growth is what she said. I said, cool, excellent. We started talking about interstate, and at the end result was, I don't care, Sydney, not Sydney. I have no bias. I don't really give a stuff. What we'll do is run the numbers, and if Sydney is the right spot, we'll buy in Sydney. If Sydney is not the right spot, we won't buy in Sydney. So I think, to answer your question, it's just really dependent, because you might have 800 grand, Brisbane might work for you, and someone at 600, it might not work for him. Or you might have 800 grand and Brisbane might work, but there's a better option in Sydney, for example. So, but it's definitely going to be easier to buy in Brisbane than it was 12 months ago. That's for sure.
It's funny, that story that you said about the dummies when you're listening to the CBA. And I was actually one of those dummies that fell in that trap. I don't know if you remember, before I purchased my home that I moved into, I'd actually purchased an off-the-plan land 2 streets behind where I actually live. So I actually have to see that house every time I take my dog for a walk and say that could have been mine. But I remember just before, like 14 days out of when COVID hit, and I purchased land there, and it was so much more cheaper back then. I'll be up front, I think I purchased one of the land, it was about 314 square meter. And I purchased the land for $298,000. Now, you probably don't have to answer this because you already know the answer to it. How much, Mark, do you reckon for a 314 square meter property in the Austral, Leppington area, Catherine Field area, how much would that be going for right now? Just the land on its own.
450.
What is it? 650 now, KM? For the land on its own? thereabouts. And I remember purchasing it for $298. And I remember seeing what you basically just said there, but previously in regards to the CEO, whatever it is from CBA, freaking everyone out that the market's going to crash, COVID's hit, people are going to lose their jobs, etc. I was one of those dummies that freaked out. Next morning, rang the real estate agent, like, yeah, sorry, man, I'm pulling out. And the real estate agent goes to me, why are you pulling out? Just because someone announced on the media, you're actually picking up a bargain. And I think a couple of months later, that same property or same land got sold for more than $450 at the time. But just going off what customers have purchased in the area recently, a minimum of $650 for the same land. And I think it's so important. I think I've definitely learned my lesson in regards to don't always listen to what the media is saying. So never listen. Call your buyer's agent, call your broker, just educate yourself a little bit more because, man, I believe, everyone else besides, on top of the media has more brain cells than the media. Because after that, I was burning. I was absolutely burning. Like, I try to avoid that house. When we're going for a walk with my dog, I try to avoid it. I just don't want to see it no more. But that's what I'm saying in regards to the point that you've made. Definitely, yeah.
I think the media, I don't think the media is dumb, but I think the media is there to do one thing, and the media is to sell, views. Or like the channel 7 or 9 or whatever, their goal is not to provide the information. Their goal is to get more people watching their program because they make more money. And the market is either, if you ever watch the news, the market's either booming or crashing. There's no in between, which is obviously an unrealistic expectation of the market. But a stable market is boring, so no one wants to read that. So yeah, I don't never take your information from the media. Call your brokers, speak to your professionals, and see, because these are the guys that are in the market day in, day out. They actually know what's happening. Yeah, for sure. So, and just in case Matt Common is listening to our podcast, I apologize for calling you an idiot, but that was like a really bad call, man. Like, you got that one way off. The market didn't drop 30%, went up by like 60. So, but feel free to come on the podcast as a guest.
I was just gonna say, we've got like many conversations with many customers since over a year, like 18 months now. Is now the right time? Is now not the right time? Is it going to go down? What do you think is going to happen? I think people who have been like since beginning of 2020, when all these media started with COVID coming out first and house prices are going to go down 30%. There's been so many people that have been on the fence since then and still haven't bought because they're still waiting for the prices to come down. And now that they're down, the interest rates are too high. We need to wait till the interest rates go down. There's never going to be a time where the prices are very good, very fair, very low, and interest rates are also record low. It's not going to happen if you keep waiting. You're just going to be sitting on the sidelines and renting for the foreseeable future.
It's actually impossible, right? Like it is impossible to time it perfectly, because if today's the bottom of the market, we don't know today's the bottom till tomorrow, right? Till it starts going back up. So today's the bottom, and we're thinking, well, tomorrow's going to be even lower, and tomorrow's not lower. Well, you missed the bottom, right?
Yeah.
So it's impossible. You're 100% right, man. And what does Warren Buffett say? Be greedy when everyone is fearful, and fearful when everyone is greedy.
Yeah.
I guess this is the time to be greedy. If you can borrow money and you can get into the market, this is the time to buy.
I was just about to mention, I reckon right now is a good time to buy, because if you're able to service a loan at these sort of interest rates and they're only going to go up, you'll be laughing in the next couple of years when your property goes up in the market again and the rates start reducing again. You'll be in a position where you're just sitting back and laughing. Yeah. And Mark's right. Like, people are always constantly asking themselves, is now the right time? Is now the right time? And I know we've mentioned on the podcast quite a number of times, this is a 30-year investment. So it's a 30-year, not saying investment, it's a lifetime investment. It's a 30-year loan term. And I think from a broker's point of view, and in case you're more than aware in this, my strategy is to try and pay my home loan down as fast as possible, but it's not ideally 30 years because you're always going to be refinancing your home as many times as possible. I think the average in Australia is 2 to 3 years you're refinancing your home, and people are not refinancing their home, or most people are not refinancing their home on the loan term that they're up to. They're just restarting their loan term to 30 years. So there's never, I don't know anyone that can answer that question confidently. When is the right time to buy property? I think every time's the right property. Every time's a good time to buy property if you're able to. But in this climate, I reckon if you can afford, or if you can, get some sort of borrowing from a bank to purchase a property right now, In a couple of years, when we're in that stage where the market's going up again, the rates are dropping, you're going to be absolutely laughing. And that's just my opinion.
Yeah. I mean, property is like, real estate's not complicated. We can look at history, and history repeats itself. Same thing happened 2008. Market kind of slowed down, went down a little bit because of the GFC and whatnot. And the people who bought then, when the market recovered a few years later, were like laughing their faces off because the amount of money they made. Where everyone was trying to jump in, because what happens, like everyone reacts in mass panic. The interest rates, when they will eventually go down to a reasonable rate, and people will be like, oh my god, this is the best time to buy property, and everyone will do it at the same time. And what happens is everyone's competing against everyone, and then everything goes up so quickly, and then you're paying 50 grand more than it's worth just to enter the market, where 6 months prior to that you could have bought the same property for probably 50 grand under value. So definitely a time to buy, but I would say you need to be buying in the right areas, because when the market is flying high, where like it was, every Tom, Dick, and Harry was making money no matter what they bought. Now people are going to get found out if they don't know what they're doing. People will be buying the wrong assets. They'll be guessing they'll be buying in the suburb close to where they live because they don't know any better, and those areas will not go up. You need to be in the right spots. So that's my last 2 cents.
Well, this is my third funny story for you. I'm just giving him out today. So again, when you say the right areas, and in 2008, my parents we actually moved into our property in the Hornsey Park area in 2009. And I remember back then the rates, I think my dad had his rate at 8.99%. That was the interest rate. And he purchased his property, I think it was under 400 grand. And again, he begged me. He's like, the double story up the street, buy it, that's gone for $389. On today's market, minimum that you would get for that property is $850. So I was constantly waking up every morning to go to work, getting in my car and seeing that yellow house up the street that I could have bought for $388. And it all goes back to the media. I remember telling my dad at the time, nah, I don't want to be paying a rate of 8.99%. I'm not going to be able to afford it. What if it goes up to 10, 12, 13? No one's going to be able to answer that question, when is the right time to buy a property? Because I've missed out on quite a bit of properties by always putting that doubt in my head, or that media doubt in my head constantly. But I think you were only, 18 or 17 at the time you went to buyer's agent, so I couldn't even give you a call to get some advice. So
I was on 6 properties by then. No, I'm joking. But it's true. I mean, and I think when we look long term, you realize, I was having a conversation with a client the other day. We were in a negotiation, literally over $2,000 for a property. I said, like, it's up to you. Obviously, at the end of the day, I can't force anyone to make a decision. But this $2,000 that we're like really fighting over, I get it as $2 grand. Firstly, on your mortgage repayments, you're talking like $3 a week, $4 a week in difference from a mortgage perspective. But 5 years time, let alone 30 years time, you won't even remember what the number was that you bought it for. Like, I don't remember what the price of my first property was. I actually don't know. Like, I know what the first number was. Like, it was a 6, and then was it a 0 and a 2? Was it a 2 and 0? I can't remember. Like, it's so long ago. Like, so these things become irrelevant, especially when you're looking at something in 20 years time, 30 years time, and losing that deal over $2 grand, and then having to wait another 3 months to find another good deal, you've probably lost a lot more than $2 grand in that time as well. So I think, always looking with the long scope of that 30-year plan or 20-year plan makes all of these conversations much easier. Just, if you're ready, now's the time. Speak to Mark, speak to Fadi, get your money, get rich.
I think it'd be interesting to get a real estate, Yeah.
I was gonna say, like, now that we're talking, like, obviously this whole time we've been talking about the current market, so it relates, and we're not going off topic, KM, so you should be happy. Like, we have a lot of people, and it's very common for our sort of clients to buy without a pre-approval, and that, back maybe a year ago, your borrowing capacity probably was the same for like 6 months, 8 months, whatever. The rates weren't really moving, and now they're constantly changing every month. And in fact, when the rates change, most banks have this thing called the pipeline policy, which allows us to still input an application before a certain date, because if we do it before a certain date, the deal will be assessed at the old rate before the new rate is enacted. And I've had so many in the last 3 months that if I put the application in 1 day later, I would have got declined. But because we're timing it so that we fall under that policy before the next cash rate, before the bank enacts the cash rate increase, they're all getting approved. So like your borrowing capacity, the whole point of that is your borrowing capacity is changing pretty much monthly, and it has been for now 5 months, I think it is, and probably will continue to change. So before signing a contract, even if you have a pre-approval, definitely, to be on the safe side, definitely call your broker before you sign anything. Run the purchase price, tell them the rental appraisal, if it's an investment property, if not, just the purchase price by them, just to make sure that this thing will service, because the broker has the same calculators that the assessors use. So we can do a very quick assessment, and we already have your calculator. If you came to me with Fadi, we already have your calculator on deck under your file, so we can quickly open it and just change whatever to whatever the current interest rate is, just to make sure it still works, so you're still safe.
That's a very good point. I'd say that's Mark's third interesting tip of the day. He's bought himself some credit.
And seriously, take that tip on board, because right now, like I said, it feels like it's a weekly thing. New policies coming through, the borrowing capacity, just to cover yourself, because Mark and Tom, we lose sleep worrying about our customers, like hoping that, you know, they give us a call just before they purchase, or making sure they still service. And man, and KM, you already know this from experience going through loans with us as well. It all comes down to the assessor that's going to be looking at your deal. It always comes down to the assessor. Yeah.
And I think, like, I 100% agree. And I think people don't think this happens to them until it does. Like, what Mark, like last week or 2 weeks ago, I called you on exactly that situation. The initial broker had told the client this was the budget. We've purchased the property accordingly, but it actually was not pre-approved. And it wasn't, and, you know, things had changed, and then all of a sudden couldn't borrow it. And obviously I sent it to you to do some firework. But yeah, 100% right. This stuff definitely happens. So you're not immune. You definitely need to keep in touch with your brokers all the time. That was a good episode, man. I think it was very nice. Mark's interesting tips and Fadi's funny stories. So
this whole structure thing's all right, hey?
It's not bad. I mean, the person who complained about the structure was one of our guests. Oh, he didn't complain. Wrong.
What a legend.
Roberto Sanz from Prosper is like, you guys jump all over the place. I couldn't keep up. So we'll try and have a bit of structure. But a lot of our listeners really want to know how Mark's day was been and Mark's week. So we're not going to get rid of that. We're going to keep asking him. So I feel, you know, we're nearly at 6,000 listeners now. So we'll keep doing it. Anything to add?
We'd have to set up a blog for Mark as well, like a daily blog for Mark, just to keep everyone up to date.
Actually, that's a great idea. Mark, I think what you should do is, if you just record yourself, like do a minute video or you're recording a day, just be like, hey guys, Mark from Power Loans, this is my tip of the day or how I'm feeling today. Send it to me. I'll upload it to the podcast. And then every day we can upload something new and just we'll call it Mark's Feelings segment.
I'm okay.
I'm keen.
No, I'm done. I'm kidding.
All right. No, thanks, boys, and we will talk next week.
Done. Thank you.
Thank you. See you later.